All right, today we are tackling a giant, Lockheed Martin. Now, as the world's largest defense contractor, they are riding an absolutely massive wave of global demand, and their order book, it's at an all-time high. But, and this is a big but, there are some serious red flags popping up just beneath the surface. So today, we're going to do a deep dive and answer the big question. Is this defense titan a solid fortress, or is it really a house of cards? Let's get into it.
I want to start with a number that is, well, it's honestly kind of hard to wrap your head around. $194 billion. That is the size of Lockheed Martin's current order backlog. It is an all-time record. And look, this isn't just some big number on a slide. It represents years and years of guaranteed future revenue already locked in and on the books.
Now, as you can imagine, a backlog like that has sent the stock soaring, right near its 52-week high. And on the surface, you'd think, hey, this is a sure bet. But as we're about to see, some pretty significant cracks are starting to appear in that armor. So the huge question we have to answer today is this. With the stock price already way up here, is all the good news already baked in, or is there actually still room for this thing to run?
So here's how we're going to figure it out. First, we're going to build the bull case. That's the argument for why this stock is a fantastic buy. Then, we're going to play devil's advocate and hit you with the bear case, all the hidden risks that could really hurt investors. After that, we'll let the financial data settle the debate, figure out a valuation, and then we'll deliver our final verdict.
Okay, first up, let's talk about the bull case. And honestly, you can't even begin to talk about Lockheed right now without looking at the world stage. The demand for what they make is so intense, it's created what you can only call a fortress of revenue.
And hey, you don't have to take my word for it. The company's own CEO, Jim Teichlet, called 2025 a year of unprecedented demand. Now look, CEOs say a lot of things on earnings calls, but when they use a phrase like unprecedented demand, everyone on Wall Street sits up and listens. That's not just corporate speak. It signals a huge shift in global defense spending, and Lockheed is right at the heart of it.
And if you want to see what that demand looks like in chart form, here it is. Just look at their Missiles and Fire Control division. We're talking about a 14% jump in sales in a single year. A lot of that's being driven by crazy demand for things like the PAC-3 missile system. I mean, that's not just growth, that is an absolute explosion.
So the bull case really boils down to this. All of that demand is built on an incredibly strong foundation, what investors call a moat. I mean, they're the biggest defense contractor in the world. The F-35 fighter jet program alone, get this, is over a quarter of their entire business. That record backlog we talked about, it means they know where their money's coming from for years to come. And at the end of the day, they're an essential partner for U.S. national security. It's just an unbelievably powerful position to be in.
Okay, so that all sounds pretty incredible, right? But that fortress isn't perfect. Now we have to pivot to the bear case, and this is where the story gets a lot more complicated. Because there are some very real cracks forming in Lockheed's armor, and frankly, what we found should make any investor take a step back and think twice.
And it all starts right here. $950 million. That's the size of the loss Lockheed had to take on a single classified program because of what they called significant performance issues. When you make a mistake that costs you nearly $1 billion, it raises some really tough questions about how well you're actually managing your most important projects.
And that massive loss wasn't just a one-off thing. It actually points to two bigger operational risks. First, their program execution. They're clearly struggling to deliver on some of their biggest contracts. And second, even on the programs that are going well, they're dealing with major supply chain and labor shortages that are making it hard to ramp up production. It really paints a picture of a company that's stretched thin, struggling to keep up with all this new demand.
So, you've got this powerful bull case and this really worrying bear case. So how do we decide which one is right? Well, we turn to the data. We're going to let the numbers settle this debate.
First up, let's look at revenue growth. This is the simplest question, right? Is the company selling more stuff than it did last year? The best way to think about it is like a cash register. Is it ringing faster this year than last year? And for Lockheed, the answer is, yeah, sales are up 6%. Now that's solid. For a company this huge, that is healthy growth. But does it really scream unprecedented demand? It's good, for sure, but it's not the kind of explosive growth you might expect from all the headlines.
Okay, next up, profitability. For this, we look at the gross profit margin. This metric is so important. You can think of it like the markup a store puts on an item. It tells you how much power they have to set prices and make a profit.
And this is where we start to see a problem. Look at both gross profit margin and their EBITDA margin. They're both shrinking. They're going down. Not by a lot, but it's a clear trend, and that's a red flag. It tells us that even though sales are going up, the cost of doing business is going up even faster, and that ties right back into those supply chain and execution problems we were just talking about.
All right, but at the end of the day, what really matters? It's cash. And for that, we look at the king of all metrics, free cash flow. After every bill is paid and every investment is made, this is the actual, real cash the company has left over. It's the take-home pay of the business.
And on this front, Lockheed is an absolute cash machine. Almost $7 billion in pure cash generated in a single year. That is a testament to the raw financial power of this business. This is the money they use for everything: paying dividends, buying back stock, investing in the future. It's a huge, huge positive.
So we have a really mixed bag, don't we? Growth is okay, but margins are getting squeezed, but then they're generating just tons of cash. So now we've got to ask the most important question. What does all this mean for the stock price? What is Lockheed Martin actually worth?
So what do the pros on Wall Street think? Well, they are overwhelmingly cautious. As you can see right here, 77% of analysts rate the stock a hold. Now, that's not a vote of no confidence, but it is definitely not a ringing endorsement. The professionals are basically telling you to just wait and see.
And this right here perfectly sums up the tug of war that's going on. On one side, you can argue it's overvalued, the stock's near its high, and those billion-dollar losses have really shaken people's confidence. But then the other side says, how can a company with a $194 billion backlog and surging global demand be anything but undervalued? This is the core conflict every investor has to wrestle with.
Which brings us to our final verdict. We've looked at the good, the bad, and the numbers. We've seen the debate. It is time to make a call. Our verdict on Lockheed Martin is a hold. The undeniable strength and safety of that massive backlog is right now being perfectly balanced out by the very real risks we're seeing in their execution and their profit margins. You just can't ignore either side of that equation.
So, we're initiating our hold rating with a 12-month price target of $650 per share. Now, that only represents a pretty modest upside from where we are today, and that's because we think the risks and the rewards are pretty evenly matched at this level.
So let's just boil it all down. The single strongest reason to hold on to this stock is that massive $194 billion backlog. It's a security blanket of future revenue that almost no other company in the world has. But the single biggest risk you have to watch like a hawk is program execution. If we start seeing more of those billion-dollar mistakes, or if their supply chain issues get worse, that will chew up their profits and our price target could be in real jeopardy.
So that's our deep dive on Lockheed Martin. It is a titan of its industry, facing both incredible opportunities and some really significant challenges. What company do you think we should put under the microscope next? Let us know in the comments below.